Imagine a company sitting on a multi-trillion euro mountain of orders, years, even a decade, of guaranteed business stretching out into the future. It sounds like a kind of problem most companies would dream of having, doesn't it? Absolute smooth sailing, clear skies ahead. But what if that very company, despite this almost unimaginable demand, is battling an invisible enemy, a persistent headwind that's keeping its full potential grounded and preventing those planes from ever reaching the runway on time?
It's a truly fascinating paradox, wouldn't you say? Here we have a genuine market leader experiencing both unprecedented, almost voracious demand and simultaneously grappling with severe, very real operational headaches. This intense tension, this struggle between immense opportunity and frustrating constraints, it truly defines their current reality.
It absolutely does. And today we're taking a deep dive into Airbus SE, the global aerospace and defense titan. We've got a detailed investment analysis that really pulls back the curtain on this company, offering you a perspective you won't find just by skimming the headlines. We're going to give you, well, a shortcut to being truly well-informed about one of the world's most critical industrial players.
Right. Our mission today is to dissect the fundamental analysis of Airbus. We want to help you understand this powerful central tension between its almost unparalleled market dominance and the very tangible near-term hurdles it faces in its day-to-day operations. It's a story of incredible highs and challenging lows, all happening at once. Really quite something.
You'll not only grasp what Airbus does, but how it actually functions on a global stage, dealing with immense pressure and equally immense opportunity. We'll be extracting the most important nuggets of knowledge and insight so you can truly understand the inner workings of this giant.
And you'll discover the surprising facts behind its competitive advantage, the frustrating realities on its production lines and within its complex supply chain, and ultimately what it all means for its future trajectory and its financial health. This isn't just about the numbers on a balance sheet. It's about understanding a global giant at a crucial crossroads.
If you've ever wondered how these colossal industry leaders manage such a delicate balance, or what it truly takes to build and deliver thousands of the most complex machines on Earth, then this deep dive is tailor-made for you. So get ready to buckle up. It's going to be an interesting flight. Okay, let's unpack this behemoth, Airbus SE. At its core, it's a global leader building everything from commercial jets we all fly on to helicopters and even sophisticated defense systems. But what immediately jumps out, what we really need to understand, is this core tension you mentioned. A paradox of immense power on one side and some very real pain on the other. Specifically, we're talking about their commercial aircraft division, especially the A320neo family, which boasts a multi-year, multi-trillion euro backlog. That just sounds gigantic. What does a multi-trillion euro backlog actually signify for a company like this?
It really is an astonishing figure, and it's critical to grasp its significance. When we talk about a multi-trillion euro backlog, we're not just throwing around big numbers for effect, no. We are literally talking about a situation where Airbus essentially has a decade, or in some cases even more, of its future production capacity already sold. I mean, imagine almost any other industrial sector, automotive, consumer electronics, heavy machinery, and trying to find a company whose entire production output is fully booked for 10 years out.
You just wouldn't find it.
Exactly. It's an exceptionally rare and, frankly, incredibly enviable position. This provides what we term exceptional revenue visibility. It means Airbus has a clear long-term line of sight to future income, which drastically de-risks their strategic planning.
Sure.
It allows them to make substantial long-term investments with confidence. The A320neo family, as you pointed out, is the undisputed core of this strength, forming the bedrock of their entire commercial aircraft business.
That sounds like an absolute dream scenario for any company, right?
Yeah.
Guaranteed business for a decade. But then we hit the pain part of this paradox, because this incredible strength is juxtaposed against severe near-term operational headwinds. It's primarily described as coming from a fragile global supply chain. So what exactly is creating this pain for Airbus? And what does this fragility mean for an investor trying to figure out if this company can deliver? Or, for the airlines that are desperately waiting for these new planes to expand their fleets or replace older, less efficient ones, that must lead to so much frustration.
Precisely. For investors, it creates this fascinating dilemma. You have an incredibly compelling story of market dominance and long-term demand, but also the very tangible frustration of, well, deferred gratification. It means that while the fundamental value is undoubtedly there, the realization of that value, the conversion of those immense orders into actual revenue and profit is being bottlenecked.
Right, it's stuck.
It's stuck. And for airlines, the impact is even more immediate and acute. They have meticulously crafted growth plans, fleet modernization targets to meet efficiency and sustainability goals, and capital commitments, all of which are being hampered by these persistent delays. They've secured financing, trained crews, and their strategic expansion is, quite literally, grounded, awaiting aircraft that are already sold but not yet delivered.
Wow.
It's a powerful illustration of how even the most dominant players are profoundly vulnerable to the intricate complexities and interdependencies of a highly globalized manufacturing ecosystem.
So, to truly understand this tension, this tug of war between power and pain, we need to look at the different engines driving Airbus's business, because it's certainly not just about those shiny passenger jets we see flying overhead every day. Beyond the headline-grabbing commercial aircraft, Airbus actually operates a surprisingly diversified portfolio, which offers a broader and perhaps more resilient picture of its overall operations.
That's a crucial point. While commercial aircraft are definitely the star of the show, contributing approximately 73% of total consolidated revenues in fiscal year 2024, which is about, $50.6 billion? The other segments are absolutely vital for understanding the company's overall resilience and its strategic depth. They offer diversification that can cushion against sector-specific downturns.
Okay, so let's start with that uncontested core, commercial aircraft. As you mentioned, it generated $50.6 billion in FY 2024. This segment designs, manufactures, and sells a comprehensive portfolio of jetliners, from the world's best-selling A320 family narrowbody to the wide-body A330 and A350 and the regional A220. What's so special about this particular business model, and why does it ensure long-term stability?
Well, what's truly fascinating here is that this business model is inherently defined by extremely high barriers to entry. I mean, think about it. The astronomical capital required to even conceive of developing a new aircraft. The mind-boggling regulatory hurdles involving safety and certification. The sheer engineering complexity of integrating millions of components. It's an undertaking that very few entities on Earth can even attempt.
Right, it's almost impossible for a newcomer.
Exactly. This, combined with significant capital intensity, meaning huge upfront investments and decades-long product cycles, it means once you're in this market, you're in for the very long haul. These factors together ensure remarkable long-term stability and competitive advantage because it's practically impossible for new players to break in and challenge the established duopoly. And, as you rightly noted, the A320neo family continues to be the market leader, solidifying its position as the world's best-selling narrow-body aircraft, making it an incredibly potent cash cow.
So while these big jets are central, it's reassuring that Airbus isn't putting all its eggs in one basket. They also have a significant helicopters division.
Indeed. Airbus Helicopters is a really consistent and, importantly, a very profitable contributor to the group. It accounted for 11% of total revenue in FY 2024, or about $7.9 billion. They hold a formidable market position in both civil and military rotorcraft markets, with highly regarded platforms like the H-145, the H-160, and the NH-90.
What's the real strategic value for Airbus in having this balanced revenue stream? Not just new helicopter sales, but also a growing higher margin services business. How does that specifically enhance the group's financial stability, especially when you compare it to the more cyclical nature of commercial aircraft sales?
That's an excellent question, and it highlights a key element of their overall strength and resilience. The services business in helicopters, covering everything from maintenance, repair, and overhaul, or MRO, to spare parts and upgrades. It provides a much more predictable and stable revenue stream. These are often at higher margins compared to the more volatile nature of new aircraft deliveries. Commercial aircraft sales can fluctuate significantly with economic cycles or major global events, as we starkly observed during the pandemic. But helicopters, especially those used for military, public service, or critical infrastructure roles, require ongoing maintenance and support regardless of the economic climate. This steady, recurring revenue from services acts as a natural hedge, effectively cushioning the company against potential downturns in new commercial aircraft orders and smoothing out the overall financial performance. For a large industrial conglomerate like Airbus, that consistent, predictable income stream is incredibly valuable.
And then we have the segment that brings both challenges and, interestingly, significant future opportunities: defense and space.
Right. This division generated about 17% of consolidated revenue, coming in at $12.1 billion in FY 2024. It focuses on providing products and services primarily to government and institutional customers. Key offerings include military aircraft like the versatile A400M transport and the Eurofighter Typhoon, complex space systems such as satellites and launchers, and secure communication networks.
What's fascinating here is how this segment's performance is so closely tied to government defense budgets and the ever-shifting geopolitical landscape. How does it offer diversification from the commercial aviation cycle, and why is that particularly important for a large conglomerate like Airbus?
It's absolutely vital because it provides a crucial counter-cyclical element, insulating Airbus from the inherent volatility of commercial air travel. When passenger traffic dips, for example, defense spending, particularly in times of heightened global tension, can actually increase or remain very stable. This diversification adds robustness to their revenue base. What's truly striking here, however, is that despite generally positive performance in commercial aircraft and helicopters, the consolidated EBIT adjusted, that's earnings before interest and taxes, adjusted for specific one-off items for FY 2024 actually declined by 8% to $5.35 billion.
Wow, an 8% decline overall.
Yes, and this decline was entirely due to a substantial loss within the defense and space segment itself. Specifically, the segment incurred significant financial charges of $1.3 billion within its space programs in FY 2024. This masked the genuinely positive performance of the air power business within the same division, which actually drove segment revenue growth.
So one struggling part of a larger division can completely obscure the success of another, even within the very same segment. How does this kind of internal complexity affect an investor's view when the headline numbers don't tell the full, granular story?
It makes due diligence absolutely crucial for any informed investor. On the surface, you see a consolidated EBIT decline, which could understandably be a cause for concern. But when you dive deeper, you realize the core commercial and helicopter businesses are actually performing very healthily and growing. The issue is localized to specific, albeit significant, problems within the space programs. For investors, this presents a nuanced picture. It offers potential for a turnaround in that specific part of the defense and space segment, but also signals a risk that these issues could persist longer than anticipated, continuing to drag on the overall financial performance. It underscores that even within a diversified portfolio, not all segments move in lockstep, and some can exert a disproportionate influence on those top-line consolidated figures.
With this diverse foundational understanding, let's now pivot and look at how Airbus is strategically planning its future amidst all these dynamics. Building on that diverse foundation, Airbus certainly isn't standing still, not at all. It's actively expanding its horizons with several key strategic initiatives that are not just about maintaining its position, but truly reshaping its future and locking in long-term market dominance.
That's a critical observation. These initiatives are not merely about incremental improvements. They represent strategic bets designed to secure long-term competitive advantage and respond proactively to fundamental shifts and challenges within the industry.
Let's start with what sounds like a real game changer. The A321XLR, which stands for Extra Long Range. This is a critical product development, essentially a souped-up derivative of the A321neo. It's engineered to fly routes up to 4,700 nautical miles, a remarkable range that was previously only achievable by much larger and much more costly wide-body aircraft. It actually began entering service in late 2024. What makes this unique capability such a big deal for airlines and for Airbus's overall market position?
This unique capability is a massive deal, truly a strategic differentiator for Airbus and a game changer for airlines. It allows carriers to open new, long, and thin point-to-point routes with the superior economics of a single-aisle jet. To put that into perspective, traditionally, if you wanted to fly, say, from a mid-sized city in Europe to a mid-sized city on the U.S. East Coast, you typically need a larger two-aisle wide-body plane.
Right, the big ones.
Exactly. Those aircraft are inherently more expensive to operate and require a much larger passenger load to be profitable. The A321XLR fundamentally alters that equation. It allows airlines to bypass major congested hubs, flying direct between smaller markets with a significantly more fuel-efficient single-aisle aircraft. This opens up entirely new routes that simply weren't economically viable before. We've seen significant orders from major global carriers reflecting this strategic advantage, including Indigo with 69 aircraft, United Airlines with 50, and American Airlines also with 50 aircraft.
And how does an aircraft like this specifically extend Airbus's dominance in the upper end of the narrow-body market, especially since its primary competitor, Boeing, currently has no direct answer? That really does sound like a powerful, almost unassailable competitive advantage.
It absolutely is. This aircraft effectively carves out a brand new subsegment of the market where Airbus currently enjoys a virtual monopoly. Boeing currently has nothing directly comparable to challenge the A321XLR's unique combination of extended range and superior narrow-body operating economics. This means that for airlines specifically looking to serve these long and thin routes, Airbus isn't just an option, it's often the only viable option.
Wow.
This not only bolsters their already commanding market share in the narrow-body segment, but also provides significant pricing power and reinforces their technological leadership. It creates a moat around this niche that would take a competitor many years and an enormous investment to even begin to contemplate building a response. So this dominance is likely to persist for a considerable period.
That's a strong play for new aircraft. But it's not just about building and selling new planes, it's also critically about the long-term support for those planes, which brings us to their focus on high-margin services.
Indeed, expanding its high-margin services business is a core pillar of Airbus's long-term strategy, and it's a brilliant one. This encompasses a comprehensive suite of offerings: maintenance, repair, overhaul, or MRO services, spare parts distribution, and pilot and technician training. While new aircraft sales are, by their nature, cyclical, this aftermarket sector provides a much more stable, recurring revenue stream that grows over time.
What's particularly fascinating here is that the global in-service fleet is projected to nearly double to over 49,000 aircraft by 2044. That's a staggering increase in the sheer number of planes flying. How does this enormous secular tailwind truly de-risk the overall business model for Airbus over the long run?
This is a truly profound, fundamental shift that profoundly de-risks Airbus's business model. As more and more aircraft are delivered and enter service, the installed base of planes that require ongoing maintenance, parts, and upgrades naturally grows exponentially. This creates a powerful secular tailwind, meaning a long-term underlying growth trend that is largely independent of short-term economic fluctuations.
Right, it just keeps growing regardless.
Exactly. The commercial aircraft services market itself is forecasted to grow at a compound annual rate of 3.5%. Extending from $150 billion in 2024 to an impressive $290 billion by 2043. This exponential growth in the aftermarket significantly de-risks Airbus. It means they're not just relying on new aircraft sales, which can be volatile. They're also generating steady, high-margin revenue throughout the entire life cycle of every single aircraft they sell, often for decades after delivery.
That's smart.
Very smart. Airbus is strategically leveraging its digital platform, Skywise, for predictive maintenance, which can anticipate issues before they occur, and expanding offerings in supply chain management and used serviceable materials, or USM, essentially high-quality, refurbished parts from decommissioned aircraft. This further solidifies their position in this highly lucrative and stable market.
Beyond current operations and services, Airbus is also looking even further ahead, at the very distant future of flight through ambitious decarbonization efforts.
Decarbonization for Airbus is far more than just a regulatory compliance exercise or a feel-good PR initiative, no. It's absolutely central to their long-term strategy and a critical competitive differentiator. They genuinely view it as both an environmental imperative and a strategic advantage that will define the future of air travel.
Why are these substantial investments in areas like sustainable aviation fuels, or SAF, and ambitious hydrogen-powered aircraft programs, such as their Zero initiative? Why are they essential for ensuring the long-term viability of its products in an era of accelerating climate change and increasing regulatory pressure?
These investments are, simply put, absolutely non-negotiable for the long-term survival and competitiveness of any major aerospace company. The global push for sustainability means that future aircraft and the fuels they utilize must significantly reduce carbon emissions. Airbus is tackling this on multiple parallel fronts. For SAF, all current generation Airbus aircraft are already certified to operate on a 50% NCF blend, with an ambitious target of 100% NCF capability by 2030.
100% by 2030, wow.
Yes, and this can reduce life cycle carbon by up to 80%. It represents an immediate, actionable step. More ambitiously, the Zero program is an audacious bet, aiming to develop and bring a hydrogen-powered commercial aircraft to market by 2035, utilizing novel propulsion systems like hydrogen combustion and advanced fuel cell technology. This is a potentially revolutionary shift. On top of that, they've set concrete corporate emissions targets, including a 63% reduction in Scope 1 and 2 industrial emissions by 2030 from a 2015 baseline, and a 46% reduction in CO2 emissions intensity of its commercial aircraft in service, which is Scope 3. These aren't just aspirations. They're essential for future-proofing their entire product portfolio against escalating environmental concerns and potential carbon taxes or regulations that could, quite literally, render less sustainable aircraft economically unviable. Without these deep investments, their products would simply cease to be competitive in the long run.
These ambitious strategies are playing out, as you can imagine, in an incredibly dynamic and highly scrutinized industry landscape, largely defined by the intense competition between two global giants. So these ambitious strategies from Airbus are unfolding against a backdrop of incredibly dynamic industry forces. We're seeing a market that's recovering vigorously from recent global events, but also one with rapidly shifting sands in both the commercial and defense sectors.
That's an excellent way to frame it. The broader macro environment plays an enormous, often decisive role in the success and strategic maneuvering of a company like Airbus.
Let's first dive into commercial aviation. Global passenger traffic has vigorously rebounded post-COVID-19, actually surpassing 2019 levels in 2024, and it's forecasted to grow another 5.8% in 2025. This sustained demand is driven by two main factors: fleet renewal, where airlines are replacing older, less efficient aircraft, and aggressive fleet expansion to meet new demand. Airbus itself projects the global fleet to nearly double by 2044, requiring a staggering 43,400 new aircraft. That's a lot of planes, but what's the catch here?
The catch here, and it's a significant one, is precisely what we discussed earlier. This incredibly strong demand is currently far outpacing the manufacturing sector's ability to supply them. This isn't just a minor hiccup. It's a systemic problem rooted in widespread labor shortages, persistent raw material cost inflation, and lingering logistical bottlenecks that plague the entire multi-tiered global supply chain.
It's that fragility again.
Exactly. This severe imbalance between demand and supply has led directly to those record order backlogs we highlighted earlier, stretching a decade or more for popular aircraft models. So while it's a boom time for demand, it's a frustrating bottleneck for actual delivery.
And the demand isn't just commercial. Defense spending is also experiencing a brand new geopolitical reality that's creating significant tailwinds.
Indeed. The geopolitical landscape, particularly the conflict in Ukraine, has dramatically shifted national priorities and security perceptions across the globe. This has led to a notable increase in defense spending, especially by NATO members who are now targeting 2% of GDP as a baseline. Germany, for instance, Europe's largest economy, has announced plans to potentially double its defense spending to a remarkable 3.5% of GDP.
3.5%. Wow.
Yes, and the European Union has even launched significant new funding mechanisms, like the $150 billion Security Action for Europe, or SAFE, program, to facilitate joint procurement and enhance regional defense capabilities.
So how does all this create a strong demand tailwind for Airbus's defense and space segment?
Yeah.
And what are those complexities you mentioned earlier that Airbus still has to navigate?
It undeniably creates a powerful long-term tailwind because governments are now actively looking to upgrade and significantly expand their military capabilities and strategic assets. This translates into potential new orders for military aircraft like the Eurofighter Typhoon and the A400M, and substantial investments in advanced space systems and secure communications. However, as you rightly point out, there are significant complexities. Increased budgets do not automatically guarantee contracts. Airbus faces fierce competition from other well-established European and American defense contractors. Furthermore, procurement processes in defense are notoriously long, often spanning many years, and they are frequently subject to national industrial priorities, meaning a country might, at times, choose a domestic supplier, even if a foreign one offers a slightly better product or price. So while the demand environment is undeniably favorable, converting that demand into profitable revenue is a complex and highly competitive dance.
This global demand, both commercial and defense, sets the stage perfectly for the enduring rivalry that really defines the aerospace industry, the battle between Airbus and its primary competitor. When we talk about the skies, particularly the manufacturing of commercial aircraft, it almost immediately comes down to the enduring duopoly, Airbus versus Boeing. And in the lucrative narrow-body segment, Airbus has truly established a commanding and, frankly, historical lead.
That's putting it mildly. The narrow-body market is, without question, the largest and most profitable segment in commercial aviation. And the A320neo family has decisively outcompeted the Boeing 737 MAX in recent years. As of mid-2024, the A320 family accumulated over 15,000 total orders, decisively surpassing the 737 family's approximately 14,300.
15,000 versus 14,300. That's a big gap.
It is. More tellingly, looking at the recent past, between 2015 and 2024, Airbus secured 8,950 net orders compared to Boeing's mere 5,012. And by July 2025, Airbus was poised to overtake Boeing in total lifetime single-aisle jet deliveries. A truly historic milestone marking a fundamental shift in market leadership that many thought would never happen.
Here's where it gets really interesting. This leadership isn't just purely about Airbus's product merit, like its superior fuel efficiency or a slightly wider cabin, or even the new A321XLR capabilities we just discussed. Is there another, perhaps more dramatic factor at play that has really amplified their lead? I'm thinking about the severe and prolonged operational turmoil at Boeing, including the 737 MAX's 20-month grounding and subsequent ongoing quality control failures and FAA production caps.
You've hit on the absolute crux of it. Boeing's very public and often self-inflicted wounds have been an undeniable and massive boon for Airbus. The 737 MAX's grounding, the tragic accidents, and the subsequent ongoing quality control failures and regulatory scrutiny, including FAA production caps, created a profound vacuum of confidence and capacity that Airbus was perfectly positioned to fill.
Right, a huge opportunity.
A huge opportunity. While Boeing struggles to ramp up, targeting around 38 aircraft per month production, Airbus is confidently progressing towards a significantly higher rate of 75 A320 family aircraft per month by 2027. This disparity in production capacity and reliability is staggering. For airlines desperately needing new narrow-body capacity, Airbus is often the only viable option right now.
The only game in town, almost.
Almost. This grants Airbus significant pricing power and market share control that few companies ever achieve. How long could this persist? Well, Boeing faces a very long and arduous road to not only recover its production capabilities, but, perhaps more critically, to rebuild its deeply eroded reputation. It would realistically take them years, if not a decade, to even contemplate developing a brand new narrow-body aircraft that could directly challenge the A320neo family. So this dominance is likely to persist for the medium to long term, barring any unforeseen issues for Airbus itself.
But the wide-body market tells a slightly different story, making it a more balanced fight where neither giant has a clear, unassailable lead.
The wide-body market is indeed significantly more competitive and finely balanced. Historically, Boeing has been the stronger player in this segment. In fact, in mid-2025, Boeing actually led year-to-date wide-body orders with 325 commitments versus 165 for Airbus, largely thanks to a significant Qatar Airways order for the 787 and the upcoming 777X.
Okay.
Looking at the active global fleet, there are 3,613 Boeing wide-body aircraft in service compared to 2,153 for Airbus. The Boeing 787 Dreamliner has also outsold the Airbus A350, with approximately 1,909 total orders versus 1,291 for the A350, partly due to its earlier market entry and a broader range of variants that captured initial demand. However, if you delve into economic analyses of direct competitors, such as the Airbus A350-900 versus the Boeing 787-9, they indicate that these aircraft are highly competitive, with the A350 actually showing a slight advantage in cost per seat mile.
Wow.
So while Boeing has a historical fleet lead and recent order wins, the product-level competition on merit is fierce and very finely balanced.
Regardless of segment leadership, the sheer volume of orders for Airbus is, as you said earlier, a truly defining characteristic. And that brings us back to the colossal backlog you mentioned.
Yes, the backlog is central to everything we've discussed today. At the close of fiscal year 2024, Airbus's consolidated order book was valued at a record $629 billion. The commercial aircraft backlog alone stood at an astonishing 8,658 aircraft, heavily weighted towards that dominant A320neo family.
Let's really emphasize this point for our listener. This represents more than a decade of production at current rates. It provides an unparalleled degree of revenue visibility and a very significant buffer against potential economic downturns. But then there's the catch. The immense value of this backlog is contingent on the company's ability to convert it into deliveries, a process that, as we know, is currently severely hampered by those pervasive supply chain constraints. What are the financial implications of having so much future revenue effectively stuck due to these production limitations? What are the opportunity costs?
This is truly the crux of the tension we opened this deep dive with. The financial implications of having so much future revenue effectively stuck due to production limitations are enormous. It means that while the demand is unquestionably there and the customers have firmly committed, Airbus isn't realizing the full potential earnings and, critically, the free cash flow from those orders as quickly as they could or would like. The opportunity costs are substantial. Every glider, every finished airframe sitting there without an engine represents revenue that isn't being recognized, cash that isn't flowing into the company, and production capacity that isn't being freed up to take on even more orders.
Just sitting there losing value almost.
Exactly. It's a classic, yet incredibly high-stakes case of having too much demand and not enough supply. but with very real multi-billion euro consequences for the company's financial performance and its ability to rapidly grow earnings.
This brings us directly to those operational realities and the significant headwinds Airbus is currently facing on its production lines. So we've talked about the colossal backlog, the market dominance, and the strategic vision. Now let's talk about the cold, hard reality of getting those planes actually built and out the door. The primary constraint, the biggest piece of turbulence on the production line, comes down to these persistent supply chain bottlenecks.
Absolutely. These supply chain issues are not just a minor annoyance. They are, without exaggeration, the single biggest throttle on Airbus's growth trajectory and its profitability right now. They dictate the pace of everything.
And the most acute and widely publicized problem is undoubtedly the engine crisis, specifically with the Pratt& Whitney geared turbofan or GTF issues. We're talking about a manufacturing defect in powdered metal for high-pressure turbine disks that necessitated a massive global inspection and recall program. What are the specific consequences of this defect for both airlines and for Airbus?
This is a truly critical point, and its repercussions are far-reaching. The recall affects up to 3,000 engines manufactured between October 2015 and September 2021. For airlines, the consequences are dire. Hundreds of A320neo aircraft have already been grounded by major carriers like Spirit, Indigo, and Wizz Air, with the disruption expected to persist significantly through 2026.
Through 2026, that's a long time.
It is. For Airbus, the impact is twofold. Both Pratt & Whitney and CFM International, which is the alternate engine supplier, have struggled immensely to meet their production targets. This has led to a critical shortage of engines for newly assembled aircraft, resulting in a significant inventory of what are colloquially known as gliders.
Gliders, that's such a striking image. So we're talking about essentially very expensive, very beautiful, yet flightless birds on the tarmac, finished airframes sitting there, essentially useless without their engines. How exactly does this directly impact Airbus financially?
You've got the image perfectly. These gliders are tying up billions of euros in working capital. Imagine having a beautifully finished, multi-million euro product that you simply cannot sell or deliver because of one missing critical component. That's a massive drag on cash flow. It directly delays planned deliveries, postpones revenue recognition on those aircraft, and creates a significant inventory buildup on the balance sheet. However, what's interesting here is a complex, almost counterintuitive dynamic. While it's undeniably negative for new aircraft deliveries, there could be a partial high-margin revenue offset from increased demand for MRO services and spare parts.
Ah, okay, so fixing the broken ones makes money too.
Exactly. When engines are grounded for extensive inspection and repair, the entire MRO ecosystem benefits, and Airbus Services is a significant participant in that. So there's a silver lining, albeit one born from significant operational pain.
Unfortunately, the challenges aren't limited to just those engine issues.
No, they're not. While the engine crisis is the most severe, Airbus has also faced consistent shortages and delays for other critical components across its supply chain. This includes aerostructures from key suppliers like Spirit Aerosystems and various cabin interior elements, such as lavatory modules for the A350. These might not grab the dramatic headlines like engine recalls, but they are equally disruptive and frustrating on the final assembly line.
How do these broader issues, even if less severe than the engine bottleneck, contribute to production volatility and really underscore the fundamental fragility of the highly synchronized, multi-tiered global supply chain that modern aircraft manufacturing depends on?
They profoundly expose the inherent vulnerability of the entire system. Aircraft manufacturing is an incredibly complex, finely choreographed ballet involving thousands of suppliers, often operating on just-in-time inventory principles. A delay in even a single, seemingly minor component, as you mentioned, something like a lavatory module or even a specific fastener, can bring an entire final assembly line to a grinding halt.
Just one little part.
Just one little part. This, in turn, delays a multi-million euro aircraft and impacts delivery schedules. These issues vividly highlight that even if the engine problem were suddenly and miraculously resolved tomorrow, other bottlenecks could, and likely would, emerge elsewhere. It powerfully demonstrates just how fragile and deeply interdependent this multi-tiered global supply chain truly is. It creates a constant state of vigilance, proactive management, and significant risk mitigation efforts for Airbus. A never-ending game of whack-a-mole.
Beyond these immediate supply chain issues, broader economic and political winds are also affecting the company and presenting their own set of challenges. So, on top of the intricate and challenging supply chain issues we've just discussed, Airbus is also navigating significant external pressures from broader macroeconomic and geopolitical factors.
That's absolutely correct. These are powerful forces largely outside their direct control, but which have a profound and undeniable impact on their operations, their strategic planning, and their overall financial outlook.
First, we have inflation and rising cost pressures. The global inflationary environment has, of course, increased costs for everything from raw materials and energy to labor. While long-term contracts often include price escalation clauses, how could sustained high inflation still manage to pressure profit margins for Airbus?
Well, even with those sophisticated price escalation clauses embedded in long-term contracts, there's often an inherent lag in applying them. Or they may simply not cover 100% of every single cost increase across the board. Furthermore, some input costs, like energy or spot purchases of certain specialized raw materials, can be extremely volatile and incredibly difficult to hedge perfectly over extended periods. So if inflation remains stubbornly high or even accelerates, it can undeniably erode the profit margins on existing contracts, especially those that were signed earlier or had less aggressive escalation terms. It's a constant uphill battle for Airbus to manage its input costs effectively in this challenging rising price environment.
Then there's the financial health of their crucial customers, the airlines. Airlines are inherently highly sensitive to global GDP fluctuations, volatile fuel prices, and sudden geopolitical disruptions. While that record backlog certainly provides a cushion, how much of a risk is a significant downturn in airline finances?
The record backlog you highlight certainly provides an unprecedented cushion, making Airbus significantly less vulnerable than it has been historically during past downturns. In a moderate economic slowdown, we'd likely see a cooling off or slowdown in new orders rather than widespread cancellations of existing ones. However, a severe, prolonged global recession leading to widespread financial distress or even bankruptcies among airlines could still lead to deferrals or, in extreme cases, outright cancellations of existing orders.
Even with that huge backlog.
Even with the backlog, even with a long queue of airlines waiting for delivery slots, managing those deferrals can create considerable administrative and financial strain, affecting precise production planning and, crucially, cash flow forecasts. So while well-cushioned, they are definitely not entirely immune to a deep systemic shock to the airline industry.
And a more specific geopolitical factor is Airbus's exposure to Russia. International sanctions in response to the conflict in Ukraine have completely cut off spare parts and maintenance support for Airbus aircraft operated by Russian airlines. What has been the impact of this?
This situation has had several layers of direct impact. Firstly, it has led to the effective grounding of a number of A320neo family aircraft in Russia, essentially removing them from the global serviceable fleet. More directly for Airbus, it represents a tangible loss of potential future service revenue from those aircraft, which would have contributed to their growing high-margin services business. While not a make-or-break hit to the overall financial health of a company of Airbus's scale, it is a clear and measurable loss of revenue in a strategically important segment, and a direct ongoing consequence of the geopolitical landscape.
All these factors, from inflation to geopolitical tensions, collectively contribute to the overall risk profile of a company operating on such a global scale, bringing us to a summary of key overarching risks.
Indeed. Understanding these vulnerabilities is absolutely critical for anyone seeking an informed perspective on Airbus's long-term prospects.
First, market cyclicality. Despite that truly substantial backlog, the fundamental demand for air travel and new aircraft is inherently cyclical and inextricably tied to the health of the global economy.
This is a foundational truth of the entire aerospace industry. While the current backlog significantly mitigates some of this risk for Airbus, it doesn't eliminate it entirely. A deep, prolonged global recession would eventually impact even the most well-protected order books.
Second, single-aisle program concentration. Airbus's financial performance is heavily dependent on the continued success of the A320 family. Any unforeseen technical issues, safety concerns, or new competitive threats to the specific product family would have a disproportionately large negative impact.
This is a classic double-edged sword. The A320 family is, without question, their greatest strength and their primary revenue generator. But it also represents their greatest single point of failure. Any major unforeseen issue, akin to what Boeing regrettably experienced with the 737 MX, would be catastrophic for Airbus given its profound reliance on this one family of aircraft for the majority of its commercial revenue and profits. It's a concentration risk they manage, but one that is always present.
Third, currency exposure. A significant risk here is the mismatch between its USD-denominated revenues, as planes are typically sold in dollars, and its EUR-denominated costs, largely based in Europe. A strengthening euro against the US dollar reduces the euro value of dollar revenues, compressing profit margins. How does Airbus manage this intricate financial dance?
Airbus employs a highly sophisticated and proactive long-term hedging program. They utilize financial instruments, primarily forward contracts, to effectively lock in exchange rates for their net USD exposure several years into the future. This strategy doesn't eliminate the underlying economic exposure to very long-term currency shifts, but it significantly smooths out the impact of short to medium-term fluctuations on reported earnings, providing much greater predictability, and giving them more time to adapt their cost base if needed over the long run.
And finally, regulatory and certification risks. The incredibly rigorous process of certifying new aircraft, like the A321XLR, means any delays in that process can postpone its entry into service, frustrating customers and delaying expected revenues.
The certification process is, rightly so, incredibly stringent and meticulous, given the paramount safety implications. But this introduces a significant element of uncertainty and potential delay, as we've seen with various programs across the industry. Even seemingly minor design changes can trigger extensive recertification processes, pushing back timelines and directly impacting financial forecasts and delivery schedules. It's a regulatory hurdle that always needs careful navigation.
How do all these operational realities, opportunities, and risks ultimately translate into Airbus's financial performance and its strategic capital management? Let's dive into the numbers. With all these opportunities and the turbulence we've just explored, let's now turn to the cold, hard numbers. A look at Airbus's financial trajectory over the past decade reveals a company that has navigated immense global challenges, but has demonstrated impressive, almost remarkable resilience.
Absolutely. Their financials tell a compelling story of a fundamentally robust company, adapting to truly unprecedented market shifts and coming out stronger despite the bumps in the road.
Let's track their revenue recovery. After a pre-pandemic peak of $70.5 billion in 2019, revenues dropped sharply, almost 30%, to $49.9 billion in 2020 due to COVID-19. Since that low point, Airbus has shown a steady and consistent recovery, reaching $69.2 billion in FY 2024, almost back to its prior peak. What does this trajectory, particularly hitting $69.2 billion in FY 2024, really tell us about the resilience of demand for Airbus's products and their ability to bounce back?
That recovery is a powerful testament to two things: the underlying insatiable demand for air travel globally once restrictions ease, and Airbus's effective management and agility in navigating through an unparalleled crisis. It vividly highlights the cyclical nature of the industry, but crucially also the incredibly strong rebound capacity inherent in the aerospace market, especially for a dominant player like Airbus. They've not just recovered, they're demonstrating sustained momentum towards and beyond their pre-pandemic strength.
And profitability. The company reported a net loss in 2020, which was understandable given the circumstances, but then returned to profitability in 2021. Net income reached $4.23 billion in FY 2024, with an operating margin of 7.7% in 2024. But as we discussed earlier, we need to consider some nuances here to understand the true underlying performance, don't we?
We certainly do. While those are very solid figures, particularly the swift return to net profitability, it's absolutely crucial to reiterate the need to account for one-off charges. Specifically, the $1.3 billion incurred within the Space division in FY 2024 significantly impacted the reported EBIT adjusted, which, as we explained, is earnings before interest and taxes adjusted for specific items. When you actually disaggregate that and look at the underlying performance of the core commercial aircraft and helicopter segments, they actually posted healthy year-over-year increases in their adjusted EBIT, indicating that the vast majority of the business is fundamentally very healthy, growing, and generating strong operational profits.
But perhaps one of the most compelling aspects of their financial story, something truly unique, is their free cash flow, or FCF, generation. It appears incredibly robust. In FY 2024, FCF before customer financing was $4.46 billion, remarkably consistent with FY 2023. This stability in cash flow, despite those significant production headwinds, truly is a testament to its savvy financial management. How does Airbus achieve such robust, stable cash generation even when deliveries are being constrained?
This FCF performance is, frankly, truly remarkable given the operational constraints and the backlog of gliders. It's a direct result of a unique and incredibly powerful financial advantage. their negative working capital model. Let's break that down. Typical manufacturing companies tie up significant amounts of cash in inventory as they build products. Airbus, however, benefits from receiving billions in customer pre-delivery payments, or PDPs, often years before an aircraft is even delivered.
Years before. Wow.
Yes. These payments effectively finance a very large portion of its work-in-progress inventory. For instance, in 2024, they had a substantial $37.7 billion in inventory, but they also had $25.6 billion in non-current contract liabilities. That's essentially customer money that's already come in funding that inventory.
So if I'm understanding this correctly, customers are essentially funding a significant chunk of Airbus's production for them, which is just an amazing structural advantage.
You've got it precisely. This structural advantage is incredibly powerful and relatively unique. It significantly reduces their reliance on external debt, substantially lowers their financing costs, and creates a stable, self-financing cash buffer. This dramatically enhances their resilience to operational shocks like the current supply chain crisis, because they're not burning through their own precious cash to build those gliders that are waiting for engines. It's an often underappreciated aspect of their financial strength that allows them to maintain stable FCF even when actual deliveries are delayed.
This robust cash generation you've described clearly underpins a very strong balance sheet, which gives them a lot of flexibility. So with all that robust cash generation and that unique working capital model, it's no surprise that Airbus boasts an incredibly fortified balance sheet and a highly disciplined approach to capital allocation.
That's the absolute bedrock of their financial stability and provides them with crucial flexibility for the future. It's a position most industrial companies can only dream of.
They ended fiscal year 2024 with a substantial consolidated net cash position of $11.8 billion. That kind of liquidity must provide significant financial flexibility to navigate downturns, fund ambitious R&D projects, and pursue strategic opportunities, right?
That level of net cash is truly a strategic asset. It means they possess the financial firepower to comfortably weather even significant economic storms, to make bold, long-term investments in cutting-edge new technologies like hydrogen aircraft, or to strategically pursue acquisitions, without having to heavily rely on expensive external debt or dilutive equity issuance. It's an incredibly comfortable and powerful position for a company operating in such a capital-intensive industry.
They also clearly maintain consistent, significant investment in their future. Self-financed R&D expenses remain stable at approximately $3.25 billion annually, supporting ongoing aircraft improvements, their decarbonization initiatives, and critical defense programs.
This sustained level of R&D investment is absolutely crucial for their long-term competitiveness. It ensures they remain at the absolute forefront of innovation, not just in developing brand-new aircraft, but also in making their existing fleet more efficient, more sustainable, and in strengthening their advanced defense offerings. It's a clear, consistent signal of their deep commitment to a long-term vision, ensuring their products remain cutting-edge for decades to come.
And their capital allocation strategy demonstrates a very disciplined approach. Let's talk about their dividend policy. They have a strong track record of consistent dividend payments, which were only paused during the very depths of the pandemic. For FY 2024, a regular dividend of $2.0 per share, an impressive 11% increase was proposed, and notably, it was supplemented by a special dividend of $1.00 per share. The current yield is about 1.5%, which suggests a growth and appreciation focus for investors.
The decision to propose a special dividend is particularly telling. It reflects not just their strong cash position, but also management's profound confidence in the company's underlying financial outlook. Despite those near-term operational headwinds, the modest current yield does indeed confirm that investors are primarily valuing Airbus for its immense growth potential and anticipated capital appreciation, effectively betting on the successful execution of their backlog and ambitious strategic initiatives, rather than for immediate income generation.
And in terms of strategic investments, we've seen discussions are ongoing for them to acquire certain aerostructures work packages from their key supplier, Spirit Aerosystems.
This is a very direct and pragmatic response to the supply chain fragility we discussed earlier. By potentially bringing critical aerostructures work in-house or under much tighter control, Airbus is clearly aiming for greater supply chain resilience and control. This is a crucial move to de-risk its ambitious production ramp-up targets and ensure a more stable, predictable flow of essential components, which is absolutely essential for achieving their lofty delivery goals and translating that backlog into revenue.
With this strong financial foundation and strategic capital management, how does the market currently view and value Airbus, especially given all these dynamic and often conflicting moving parts? Okay, let's turn the market's lens on Airbus. How is it currently valued? And what does that tell us about investor expectations for this complex, high-performing, yet challenged company?
Valuation for a company like Airbus requires a highly nuanced approach because traditional metrics can be easily distorted by the industry's inherent cyclicality and the significant impact of those one-off charges we've discussed. It's rarely as simple as looking at a single number.
On a trailing 12-month or TTM basis, Airbus's price-to-earnings or PE ratio is hovering around 29.30x. This is significantly elevated compared to its 10-year historical average of 7.8x, a figure that was, as you might expect, heavily distorted by low or negative earnings during the pandemic. This volatility really underscores its limitations as a standalone valuation tool, doesn't it?
It absolutely does. That historical PE average is almost misleading given the unprecedented events of the last few years. That's why we also look at enterprise value to EBITDA, or EV/EBITDA, which tends to be a more stable benchmark, less susceptible to short-term accounting distortions and one-off events. The last 12 months, EV/EBITDA was approximately 15.1x, with some sources placing it closer to 20x. This is notably higher than the aerospace and defense industry average of around 10.1x from late 2023, clearly suggesting a premium valuation. Their price to sales, or PS, is around 1.9x.
So these multiples certainly appear high. What's the market looking beyond the immediate operational challenges for? Why is it pricing in the eventual and successful conversion of its massive order backlog into future earnings and cash flow? It feels like a lot of optimism.
That's the crucial insight, and you're right, it's a significant amount of optimism. The market is fundamentally not valuing Airbus on its current earnings, which are demonstrably suppressed by those persistent production bottlenecks. Instead, it's making a powerful, forward-looking bet. Investors are anticipating that the supply chain issues will eventually be resolved, and when they are, Airbus will be able to convert that colossal $629 billion backlog into an immense surge of future revenue, earnings, and critically free cash flow. This premium valuation is essentially a strong vote of confidence in management's ability to execute that massive ramp-up successfully, and in the sheer undeniable volume of future business the company has already locked in.
But that, of course, creates a significant valuation risk. If those supply chain constraints persist longer than anticipated, delaying that production ramp-up, it could potentially lead to a derating of the stock. That's a lot riding on execution.
Absolutely. The current valuation effectively bakes in a high degree of optimism and a very specific timeline for that execution. If those timelines are missed, if the engine issues persist or new significant bottlenecks emerge, then the market's earnings expectations would have to be pushed out even further into the future. This could very well lead to a correction in the stock price, even if the long-term fundamentals in the demand story remain incredibly strong. It's a classic case of future potential being heavily discounted into the present, with the associated risks if that potential isn't realized as quickly as the market anticipates. How does this stack up against its arch-rival and other industry players? Does this premium hold up? Let's put Airbus's valuation into further context by comparing it to its peers in the industry. Peer comparison is an essential step to truly understand whether a company is, in the market's eyes, truly undervalued, overvalued, or fairly priced, relative to its direct competitors and the broader industry.
A direct valuation comparison with Boeing is currently challenging, if not almost impossible, on certain metrics. Due to Boeing's very recent net losses, its price-to-earnings ratio is negative, which obviously isn't meaningful for comparison, so we have to rely on forward estimates or revenue-based multiples there.
That's a key point of divergence and a stark indicator of the different paths the two giants are on right now. Boeing's ongoing operational and financial woes make a like-for-like comparison on profitability metrics almost impossible right now. Any meaningful comparison would have to assume a substantial recovery for Boeing, which introduces a significant variable and a lot of speculation.
When compared to a broader set of European industrial and aerospace peers, Airbus's valuation appears relatively full. Its PE of around 29x is broadly in line with the European aerospace and defense industry average of 33.5x, but it's noticeably higher than many other large-cap industrial companies outside of this specialized sector. And Airbus's 2025 guidance itself points to rather modest growth, with targeted deliveries of around 820 aircraft and EBIT adjusted of approximately $7.0 billion.
This is a crucial distinction. These new-term figures alone, for 2025, do not appear to justify the prevailing high multiples we're seeing today. What this tells us, yet again, is that the valuation is profoundly predicated on achieving the ambitious long-term production ramp-up of 75 single-aisle aircraft per month by 2027.
It's an investment, pure and simple, in a future where that colossal backlog is efficiently converted into robust revenue and earnings. If you're only to look at the 2025 guidance, the stock would appear expensive. But the market is projecting far beyond that, assuming a successful navigation of the supply chain issues and a sustained period of high production rates in the latter half of the decade.
So it's very much a bet on future execution rather than just current performance.
Exactly right.
And who is guiding this incredibly complex company through these immense opportunities and equally significant risks? Navigating a company of Airbus's scale and strategic importance through such complex market dynamics and persistent operational headwinds requires truly strong leadership and a very robust governance framework.
Absolutely. The quality and experience of management, along with the structure and effectiveness of its governance, are absolutely critical elements in assessing the long-term health and stability of any major corporation, especially one with such global reach.
Let's look at the leadership at the helm. CEO Guillaume Faury, who was appointed in April 2019, has an incredibly deep background in engineering, flight testing, and previously led Airbus helicopters. He's certainly been tested by fire, having steered Airbus through the tumultuous Boeing 737 MAX crisis, the unprecedented pandemic shutdown, and now these ongoing challenging supply chain disruptions. His performance is primarily judged on two key metrics: the critical production ramp-up and the strategic repositioning and turnaround of the defense and space segment.
Faury's extensive operational and technical experience is, without question, invaluable in his role, especially considering the inherent engineering complexities of aircraft manufacturing and the very real production challenges they currently face. He has truly been a leader in the eye of multiple storms, guiding the company through some of the most turbulent and challenging times in aviation history. His ability to deliver on those aggressive production ramp-up targets, and crucially, to orchestrate a successful turnaround in the problematic parts of the defense and space segment, will undoubtedly be the defining measures of his legacy.
The CFO, Thomas Toepfer, is a relatively recent addition, having been appointed in September 2023. He joined from Covestro AG. His key responsibilities include managing that incredibly strong balance sheet, overseeing the complex and vital currency hedging program, and ensuring rigorous financial discipline amidst heavy ongoing investments.
Toepfer's role is incredibly important right now, perhaps more than ever, with billions tied up in working capital due to those gliders and the continuous need for substantial R&D and strategic investments. His financial stewardship is paramount. The currency hedging program alone is a massive and intricate undertaking, specifically designed to protect billions in revenue from exchange rate volatility. His disciplined approach and strategic financial acumen will be absolutely vital in ensuring ongoing financial stability and the most efficient deployment of capital.
The board of directors, chaired by René Obermann, the former Deutsche Telekom CEO, is composed of 12 members with diverse professional backgrounds, encompassing industry, finance, technology, and governance. They have an average tenure of 6.8 years.
A diverse board with a reasonable average tenure like that provides a very good balance of deep institutional knowledge and fresh, outward-looking perspectives. This diversity of thought and experience is absolutely essential for effective oversight of a global company with such a broad and complex range of operations and challenges.
And what about the overall governance framework that guides this leadership?
Airbus operates as a Societas Europaea, or AE, which is a corporate structure specifically designed for pan-European companies. It's legally registered in the Netherlands, but its primary operational headquarters are located in Toulouse, France. The board has three principal committees: the Audit Committee, which focuses on financial integrity; the Remuneration, Nomination, and Governance Committee, covering executive pay and board composition; and notably, the Ethics, Compliance, and Sustainability Committee. The presence of that last committee, the Ethics, Compliance, and Sustainability Committee, is particularly telling, underscoring the increasing strategic importance the company places on ESG, or environmental, social, and governance matters in today's demanding corporate landscape.
A notable and distinct feature which sets Airbus apart is the significant stakes held by European governments. France, through SOJA, Germany, through GZBV, and Spain, through CEPI, collectively own approximately 25.8% of the shares.
This government ownership definitely provides a degree of strategic stability and support. Governments often act as very long-term shareholders, less swayed by short-term market fluctuations, and can provide crucial political backing for major projects and investments. However, it can also, at times, introduce political considerations into corporate decision-making. These political interests, which might include national priorities like job preservation, industrial policy, or even specific national security agendas,
may not always align perfectly with the pure commercial interests or objectives of minority shareholders. It's a complex dynamic that investors absolutely need to be aware of and factor into their analysis.
Wow, we've covered a lot of ground today. Let's bring it all together now and identify what you, our listener, should really be paying attention to as you think about Airbus. What an incredible deep dive into Airbus SE. From its dominant position in the skies to the very real turbulence on its production lines, it's truly a company of stark and fascinating contrasts. Let's synthesize these findings into the big picture, the key takeaways, for you, the learner.
Indeed. It's about distilling what truly matters most from all this rich and detailed information.
First, that sustainable competitive advantage. Airbus's commanding lead in narrow-body aircraft, anchored by the A320neo family, the game-changing A321XLR, its massive backlog, and Boeing's persistent operational issues, appears highly sustainable for the medium term. We're talking 3 to 5 years. It would realistically take years for Boeing to even begin to catch up, if they could at all.
Absolutely. This isn't a fleeting advantage. It's deeply entrenched and robust. Second, regarding the realistic production trajectory, you should realistically expect a slower and more volatile ramp-up than the company's ambitious official targets. The Pratt & Whitney engine issues are, without a doubt, the single greatest constraint and simply won't be fully resolved before 2026.
Not before 2026.
No. Therefore, the ambitious target of 75 A320 family aircraft per month by 2027, while commendable, carries significant execution risk. You should anticipate a more gradual, perhaps bumpier climb to those rates than a smooth linear ascent.
Third, concerning their exposure to potential downturns, Airbus is remarkably less exposed than at any point in its history, primarily due to its impressive 8,658 aircraft backlog and that growing, higher-margin services business. While no company is entirely immune, a moderate economic downturn would primarily slow new orders, which the company can easily absorb for a considerable period without impacting existing delivery schedules too dramatically.
Correct. That colossal backlog acts as a powerful insulator against most economic shocks. Fourth, the key value drivers for Airbus. The primary driver is, unequivocally, the successful execution of the commercial aircraft production ramp-up. This means translating that immense backlog into tangible revenue, earnings, and most importantly, free cash flow. Secondary but still significant drivers include the profitable growth of the services business, which benefits from that long-term secular tailwind, and a much-needed turnaround in the defense and space segment's problematic space programs.
And finally, that critical point about valuation versus intrinsic value. The current market valuation for Airbus appears full and reflects a very significant degree of optimism. It's actively pricing in the successful execution of the production ramp-up in the latter half of the decade, not just the near-term earnings, creating a very real risk if those critical delays persist longer than anticipated by the market.
To give you a practical framework for thinking about this, let's quickly consider a couple of scenarios. A bearish scenario would involve a persistent failure to fully resolve those stubborn supply chain bottlenecks, particularly with the engine issues, leading to significant delays or further downward revisions of production targets. This would inevitably postpone anticipated earnings growth and likely trigger a valuation derating. A severe global recession causing widespread airline bankruptcies would also, of course, be highly detrimental. On the flip side, a bullish scenario would see a faster-than-expected resolution of those supply chain issues, allowing Airbus to significantly accelerate its production ramp and pull forward revenue and cash flow from its massive backlog. Continued market share gains from a persistently troubled Boeing, combined with major new contract wins and a strong turnaround in the defense segment, would provide further significant upside.
So what specific key metrics should you, our listener, really keep on your radar if you want to track Airbus's journey?
Definitely monitor the order intake and backlog evolution, specifically keeping an eye on quarterly gross and net orders, especially for wide-body aircraft, and the total unit backlog and its value. Most critically, track delivery rates and production ramp progress. Compare quarterly deliveries against company guidance and pay very close attention to management commentary on reaching that ambitious 75 A320 family aircraft per month rate. Also, watch cash flow generation and conversion by tracking free cash flow before customer financing quarterly to assess working capital performance and underlying cash generation. Keep a sharp eye on market share trends, continuously comparing Airbus's monthly orders and deliveries against Boeing's across both narrow-body and wide-body segments. And finally,
Monitor the defense and space segment performance, especially its quarterly EBIT-adjusted margin for signs of a turnaround, major contract wins, and updates on problematic space programs.
Airbus stands at an absolutely fascinating crossroads, a company with an almost unimaginable amount of guaranteed future revenue, yet acutely vulnerable to a handful of tiny, critical components from its incredibly complex supply chain. What does this profound paradox tell us about the true nature of globalized manufacturing and the systemic risks even the most dominant players face in securing their future? It's a compelling thought for anyone interested in the giants of industry and a perfect, thought-provoking way to end our deep dive.